Hey everyone, good morning and good afternoon and welcome to today's webinar, Millennial Credit, the Insights You've Been Missing. My name is Reshma Peck and I'm with Experian's Consumer Credit Information Services and also your host today. So millennials have certainly dominated the headlines over the past couple of years and certainly this year, 2015, where they officially became the largest living generation. We've all heard the stereotypes and mass generalizations, but today we're going to dig much deeper, specifically show you how they're growing and managing their credit and what it means for lenders as we attempt to capitalize on this growing segment. And there's really no better individual to share these insights with you than our very own Michele Raneri. Michele is our VP of Analytics and Business Development at Experian, and she leads our team of experts who interpret our financial data to in turn help our companies make informed decisions in the marketplace. Her insights regarding credit analytics, the economic climate, and credit trends have been featured in the Wall Street Journal, Fox News, Forbes, MarketWatch, and many other industry-specific trades. And she's frequently been quoted on how this massive generation is adopting and utilizing credit. In fact, she was just on stage at Money 2020 a few weeks ago talking millennials. So, all right, but before we get started, here's a few basic housekeeping items. There is a Q&A tool on your console. So if you have any questions for Michele during the session, I'd encourage you to type them in and hit send. We'll try and address as many as we can at the end of the session. Additionally, we'd love for you to provide us with feedback on this webinar. So please fill out that survey at the conclusion of the session, which is also featured on the console. Again, thanks for tuning in today. And with that, Michele, I'm going to turn it over to you.
All right. Thank you, Reshma. So for our agenda today, we're going to talk about trends. We're going to look at some cohort analysis and a specific study that we did for comparing the different generations. We're going to look at entrepreneurs in the millennials, and we're going to go over some sophisticated segmentation. So first of all, millennials and credit trends, some of the insights that you've been missing. Let's level set on the generational time periods, generational ages. For these studies, millennials are 18 to 34. They make up 21% of the file, and their average age is 21. Gen X, or the busters, are 35 to 49. They're 22% of our file, and their average age is 42. The baby boomers are 50 to 68, 27% of the file, and age 58. And the greatest, or the silent generation, is 69 or older and 17% of the file. Their average age is 81. There's an additional 12% population that's unknown and not accounted for in the file just because they don't have age. So we're going to really focus on the millennials, and I'm going to use probably all of the generations here, but really focus on Generation X as a comparison most of the time. Since I said that the millennials were only 21% of the file, I don't want you to think, that's not very much, why are we here? It's because they are the largest generation that we have right now. They are the kids of the baby boomers who were a huge population after World War II, and they're more than 75 million right now. So as this group continues to grow and they continue to use credit, this is your growth segment. This is your growth opportunity. So I want you to think about millennials for a second. Think about the magazines that Reshma showed you. Think about what you know with your own experience with millennials. And now I'm showing you what I've compiled from different relationships and interviews that I've done. That they go to high school and they graduate, and then they travel. And then they go to college, and then they travel some more. Usually they get to go to Europe for an after-college break. Then they become a barista or they work for a nonprofit, and then they move home. And then they like to go to Coachella or South by Southwest. Now, some of you are thinking, I don't know what Coachella or South by Southwest is. If you're a Gen Xer like me, you're thinking Lollapalooza. Or if you still don't get it, Woodstock. So it's kind of like Woodstock for millennials. Austin and Portland seem to be the place that they want to move to. They get an apartment when they move out finally in one of these towns. They kind of like the mantra of keep Austin weird, I think. And then they follow their passion. And that passion may be that they fall in love or it might be that they love developing apps, or they want to produce a high-tech video, but they find something that they're really passionate about, and that is when they need credit. They find that they don't have enough cash on hand to buy some of the big things that they need, like funding a new business or buying major appliances. And this is when they start to also think about the longer term of what if they would like to get a house one day and they realize there's no way they're going to save enough money for a house. And so building credit to be able to get a mortgage is now important. So how does this translate to the world of credit? Let's look at millennials and their balances first. Now this is something that we're looking at a little bit differently probably than a lot of you have seen it, because we isolated each one of these debt types and looked at the average. So instead of picking up all of the millennials and saying, what's the average mortgage for all these millennials, if you pick them all up without isolating mortgage, then you're going to get a much lower number because it's going to get kind of washed out by all of the people who don't have mortgages. This number represents just those who have a mortgage, which is $185,000 for those millennials who have a mortgage right now. Same for the bank card, $3,000, auto, $17,000, and student loan debt, $28,000. Now, to put this into perspective, I wanted to do something that was an apples-to-apples comparison to see what this would mean. So instead of just comparing this to just the Generation X right now, because that's not a really good comparison, we picked up 40-year-olds in Generation X, pulled them back in their credit file 10 years ago to see what they looked like when they were 30 years old and compared them to 30-year-olds right now. And what we see is the purple bars are Generation X at age 30, and Generation Y, or the millennials, right now at age 30 are in green. And you see that retail, bank card, and auto are all about the same. Bank card's a little bit lower for the millennials right now, but I think that most of that is because of the CARD Act, a little bit of an impact because of the restrictions on soliciting to them before they're 21. But then the big differences are in mortgage, the $163,000 compared to $185,000 for the millennials now. That is a 13% increase, and I believe that's partly due to increased housing costs, just because houses cost more now than they did 10 years ago. And they also have the ability to get 97% LTV loans, loan-to-value loans, because of FHA and other packages that they're able to take advantage of. And so they actually can borrow more money now than Generation X could 10 years ago for a mortgage. And then student loan. Student loan is the most difference at 62% difference, partly because of increased cost of school, but also because families have lacked equity in their houses in the last several years. And so whereas a family might take out a home equity line of credit or a home equity loan before, they can't do that anymore. And so they send their kids off to school and have them get their own student loans now more than they used to. Let's look at Vantage Score by generation. Vantage Score is a generic credit score. It ranges 300 to 850. It predicts the likelihood of a consumer going 90 days past due or greater within a 2-year period. And we have this broken out from 2011 through 2015. Each one of these groups has each of those time periods. And then the groups that are represented are the Millennials, Gen X, Boomer, and Greatest. You'll notice that the Millennials have this tiny stair-step effect. So about every year, they increase 2 to 2.5 points per year. And they're currently, I think, at 629 is their average. Generation X currently is at 653. Boomers are at 700, and the Greatest Generation's current Vantage Score is at 729. Notice the pattern of each one of these, because the Millennials continue to grow. Generation X has had some slow growth at the beginning, but has grown recently. And then, as you see, the Greatest Generation, as they quit using some of their major credit and probably start to shed some mortgages if they pay them off, then their credit scores decrease slightly. And then let's look at the distribution advantage score for Generation X and for the Millennials. Let me tell you first, the reason that this curve looks funny, usually when you see a curve, you expect it to look more like a bell curve where it's higher in the middle. This is because the way I like to split it out has the deep subprime, that non-prime group, and then prime and super prime. The non-prime group, notice that it's only 600 to 660, so its score range isn't as big, and so the population also isn't as big. But I like to have it broken out because this is kind of part of the gray zone. This is where it's hard to make a decision sometimes of what to do with consumers or in your policy, because prime's pretty easy and really deep subprime is easy, but it's when you get into that 5 and 6 to 660 range that people usually need help when they're making policies as lenders. And so what I see in this, though, is that there is a shift towards the deep subprime and the subprime for the Millennials with the 10 and 31%. So that's a total of 34% deep subprime and subprime compared to Generation X being, the 41% for Millennials and 34% for the Generation Xers. And so you see that shift downwards for the Millennial population. Now let's look at the average balance trends. Now we're really focusing now on the trends of auto, bank card, student loan, and mortgage. And what's graphed is 2012 to 2015. The auto, bank card, and student are on the left-hand axis, and the mortgage, because it's so much more, is on the right-hand axis. And what's important on this one is that auto and student loan have about the same increase. The increase is what's represented on each of the slides, the 3% or 12%. So that auto and student loan have about the same increase from the U.S. to the Millennials. But what's important to see is that for mortgage, the U.S. has had a 3% growth since 2012, while the Millennials have had a 14% growth. And bank card, also important to notice the change. U.S. has been a 2% increase, while Millennials have been a 19% increase. And so it's a good thing to recognize where these growth patterns have already begun. Now, what about delinquency? Looking at 60 days past due for the U.S. versus Millennials, mortgage and auto, the U.S. are both at 60 basis points compared to 80 basis points for Millennials. Now, that's significant because that's a 30% increase in delinquency. So we'll see a couple of times through this that this group is a risky group. Their Vantage scores are lower, their delinquency is higher. And then let's look at bank card and student loan from 50 basis points to 60 or flat 50 basis points. Student loans are pretty flat across the board because a lot of the Millennials may still be in deferment. And so we'll wait and see how those trend in the next coming years as they get out of school and actually start the repayment period. Now we have market potential. Now this is where Millennials could be going in each of these products in the future. Now I'm going to give the caveat, the disclaimer, that this is market potential. Don't use this for investment. We didn't develop these for you to use them in some sort of a market investment or divestiture, but something certainly we could do. But this was just to give us an idea of where we think the market could be going for this population. So looking between 2012 to 2015 and including some other macroeconomic and data that we have, we estimated that by 2020, mortgage will grow to $137 billion, 73% increase, that the student loan market will grow for the Millennials to $43 billion, 43% increase. Auto will grow to $29 billion for a 71% increase, and mortgage, which is again on the right-hand axis, mortgage was on the right-hand axis for the first one, and then bank card is up to $10 billion for a 67% increase. So there is significant growth in this population if you learn how to work your business and do your strategy to attract them. So now let's turn to small business. We looked at millennials who are entrepreneurs and looked at their student loan debt. Notice that their balance, which is on the right-hand side, is lower, as well as the student loan repayment, which is on the right-hand side axis, that it's lower than Generation X and baby boomers. So knowing that this group is 18 to 34, they may still be accumulating some, but this finding was still a little surprising to us, and so we dove deeper into it and overlaid demographic data, first of which was education level. So we looked at the education level for each of our 4 generations and grouped them by less than a high school diploma, some college, a bachelor's degree, and a graduate degree, and found that the millennials have the largest of the business owners with less than a high school diploma on the far left, and that they had the smallest percent of business owners with less than a bachelor's degree in the middle. So this really looks like it is a entrepreneur group who has less education and less student loan debt than previous generations. So we went a little bit deeper into this to see what type of businesses do they own in what industries. So we looked at the top 10 industries and found that of those, millennials' top are business services, building cleaning, general contractors, and motion picture or video. And we had one more layer that included gender and found that males are starting small businesses that really don't require 4-year degrees as much. So putting all of that together and looking at what the small business or the entrepreneurial millennial looks like gives you a pretty good picture. The other thing we noticed is that from this top 10 list, there were 3 industries that were noticeably missing for millennials, and they were real estate, consulting, and the gift and novelty. So real estate and gift and novelty were dominated by another demographic group. And then consulting, I think that most of that just has to do with not having the level of experience for consulting yet. Some may, but it's in general, they haven't risen to that level of expertise. And I think that group's mostly in the baby boomers and Xers for those jobs still. So who to target? We did some analysis to look at risk and revenue and those trade-offs for bankcard. And the way that we did this testing was we did a chi-square or a shade analysis, and also did a revenue calculation and then merged the two for a balance of that revenue and risk to get to like that ideal millennial and how to make choices for those that are not ideal. So we're going to do the risk first. We're going to start with the chi-square or the shade analysis. If you're not familiar with the chi-square shade analysis, it stands for a chi-squared automatic interaction detection. What that means is that we do regression on multiple variables and do segmentation and find the best predictors for our dependent variable. So all of that is a fancy way of saying we do segmentation, looking for the probability that a consumer is going to go 90 days past due, and in this case, specifically on a bank card. To do this, we pulled in Vantage Score, the Experian TAPS, which is total annual plastic spend, Trend View data, so trended data longitudinally over time, Premier Attributes, EIRC, the estimated income rate calculator, and debt-to-income data. We put it all through the shade analysis and had an observation period of September 2013, meaning we picked it up in 2013, retrospectively and then kind of pulled it forward to September 2015 and then observed that population to see which ones went 90 days past due, and then we separate them and put them into a decision tree. So this is what comes out of it. This is the decision tree with just 3 levels down. So I don't know if you're able to see these. So the top one is Vantage Score. Vantage Score has the deep subprime, non-prime, prime, and super prime like we saw a couple of slides ago. And you'll notice that from deep subprime to super prime, that the bad rate, that's what's in the parentheses, the 7% to the 20 basis points, that it goes in a straight line. That means it's monotonic. It's going from it being the lowest score and the highest risk down to the highest score and the lowest risk, exactly as you would expect a model to go. The overall bad rate for this population on BankCard was 1.2%. So we're going to use this as our target of what to beat, a hurdle or a benchmark, if you will. The other 2 levels that we went past Vantage Score was the BankCard utilization rate. So how much are they using their card? I think on the first node, most of them are less than 10%. And then as they increase their utilization, you'll see that their bad rate increases, their riskiness increases. And then the third level is delinquency. So have they had any delinquency even at 30 days past due on a bank card? So using the 1.2 as your benchmark, you kind of look at these and say super prime, so they're much better than the benchmark. The prime's better than the benchmark. But then you come to non-prime. And that 2.3 compared to the 1.2, if you were making just a cut because you wanted to be very safe in your risk, you might cut off all of non-prime and say, we're just going prime and super prime. And what this is going to show is through segmentation, there are some ways to mitigate this risk and maybe make some choices to swap in some populations. So I'm isolating the non-prime population. Remember, it's 2.3, which is further than the 1.2 for the overall. But if you look down in this one node that I have pointed at, that its bad rate is 1.6%. And so it is 1.9%. It is slightly higher than the 1.2 overall bank card bad rate. And so you might be able to, I got that right? 1.0. I'm sorry, I'm not able to see it. It's 1.0, so it is less than the bad rate for the overall population. And so that means that that is the swap-in population that you can bring in that you would have left on the table if you had only done a cut on the credit score and left non-prime out. And so pull those in and you're able to keep them. But because they're kind of close, you might still watch them, but they're definitely in the protect or attract treatment group. Then secondly, we're going to move down the line. This group has a bank card utilization of 10 to 49%, so they're higher utilized, but they've never had delinquencies either. They have a 1.2% bad rate, so this is exactly the same as the overall bad rate. So it's the same as the average. So if you're being risk averse and you're just looking at risk, you might put this on the watch list because it's not better than the overall bad rate. And then finally, still moving down the non-prime line, seeing how there's 3 different segments within this greater group of the non-prime Vantage Score group, is looking at the bank card utilization that's over 50%. Let me note that this over 50% group has a 2.2% bad rate. So if you just looked at utilization, you would say, I don't want to mess with the group that has a higher utilization because that looks too risky for my portfolio. But then you go a little bit deeper, finding that never delinquent population again, and it's 1.7. It's still a little high if you're risk averse because it's more than the 1.2 overall rate, but you can still originate them, or if you already have them on the book, you want to watch them closely and do close contact with them so that if they do go late on you, that you recognize that they're a little bit worse than other millennials that have bank cards. So now we'll look at the revenue side of the equation. We just looked at risk. Now let's take a look at revenue. The main components that we pulled in for this part of the analysis was the Experian TAPS, which is the total annual plastic spend. It's a spend algorithm that uses the longitudinal data over 12 months and determines what that charge card spend is. And the charge card and credit cards are like the FDIC definition that includes all types of plastic. We return fields that are the total annual plastic spend. We return the wallet share and the payment rate. And then we also included the EIRC, the estimated interest rate calculator for revolving, and it's a yield algorithm. It's also using longitudinal data, and it looks at the interest rate that are on credit cards. The fields that are delivered back for that are the average effective APR in a percentage, the average interest rate in dollars, and then the average daily balance and the average revolving balance. So then to do the revenue calculation, we have the revenue interest rate, or the revolving interest rate, and then we annualize that by multiplying it by 12. So we come up with an annual yield. Then we get the spend, annualize that, and multiply it by 0.0167 to get the estimated interchange for a year. Add those two together, and that way you have the overall consumer revenue for a year. So with that, we rank ordered it for both the Generation X and the Generation Y, and then split it into thirds, 3 equal parts, and found the mean for each one of the groups. So for Generation X, the high was $2,600 versus Millennials $1,600. Generation X was 39% higher. And then for Generation X, the medium grade was $637 compared to Millennials at $394. The Generation X was 38% higher. And then for low, the mean for the low third was $116 for Generation X and $67 for Millennials, which was even more at 42% higher. So what this illustrates, with each one of these showing that Millennials are much less revenue than Generation X, is that this isn't a huge revenue stream for you yet. And so we recognize that this is a little bit riskier of a population and the revenue isn't quite there yet, but you cannot ignore this population. You need to learn how to attract them and work policies that are going to work to graduate them and bring them into your portfolios and reward them for good credit behaviors. Because, as we pointed out, this is the growth potential. This is where the population is growing now. Let's take a quick look at the profiling for Millennials compared to Generation X. We've got a lot of stats here. Revenue, Generation Y or Millennials, $695 compared to $1,143. The total annual plastic spend is $13,000 for Millennials and $20,000 for Gen X. The average bank card balance is $3,000 for Millennials and $6,600 for Gen X. The debt to income is interesting. 14% for Millennials compared to 16% for Gen X. So I looked a little bit deeper into this, and it's lower mostly because the mortgage occurrences simply aren't there. So many more Generation Xers have that mortgage, and that pulls that debt to income up. And so I expect that while it's only a 13% difference right now, that that's going to, the debt to income is going to increase and the difference is going to go lower. The average income is $41,000 for Millennials and $53,000 for Generation X. Vantage score is 635 compared to 657 for Generation X. This is a 22-point difference. And just as a rule of thumb, I usually use 20 points as an indication of what's significant and difference of a Vantage score. And so being 22 points, that's a pretty big difference between the two. And then bank card utilization. Millennials have 42% compared to 40% for Generation Xers. I think the reason that that is higher is partly because they're still learning how to use credit, but the other reason is that they don't have the property or the mortgages yet to be able to get a home equity loan or a home equity line of credit that sometimes people will use in order to increase their cash flow and to increase their purchasing power. And so that's offset by not having a mortgage again. And then their 60 days past due on bank card is 2% for millennials and only 1.8 on the Gen X population. So now we wanted to merge together the risk and the revenue components to help you find where those pockets are that you might have a hard time making a decision on for policies and for lending. So there's 4 different components that we looked at. There's the release, watch, protect, and attract. Release has high bad rates and high overall risk, and they have the low revenue. So the treatment is to do a decrease of their credit line or even to close them. And if you haven't attracted them yet, this is something to notice in your strategy so that you don't bring them into your portfolio or if they're right on the edge so that you have to take these measures on them. The next is a watch segment. This is where you have kind of a mid or a low risk, and you have mid to high revenue, so they're right in a zone. You might want to do a credit line decrease for them also, or closely monitor their lines. This is also a group that sometimes groups will slip into after you've already got them on the portfolio, and so you might need to do a lot of communications with them and find ways to mitigate that risk when they're already on your portfolio. The next group is the protect group. You have mid to low risk and medium high revenue. So this actually is a pretty good group. The protect group, though, is the group that has a high on-us utilization. And by on-us utilization, I mean that they have you have the high market share, or you have the high top of wallet. So if they have multiple cards in their wallet and that they're using, and through the analysis you find that they actually prefer to use you, then that is definitely a place that you need to protect them. And so if they have a higher utilization on you, you might want to increase their credit lines so that you're able to continue that wallet share and facilitate that relationship also with them. And then finally, the attract group. So attract is also mid to low risk, medium high revenue, and this is where they have a high off-us utilization. So opposed to the protect group, this group you don't have a high top of wallet or a high market share with. You can see that they have other credit cards, but they're preferring to use somebody else's card over yours. And so you still want them as a consumer and the customer, but you want to be able to bring more of their spend onto your card. And the way to do that is usually to improve their rate or to consider that credit line increase, but you need to recognize what really fits for them and their credit needs at the time. Okay, so for the millennial segmentation, let me explain what we did with this one. What we decided was to focus on the areas where you might want to be thinking about where you would need help. And so where you need help is not in that group of the business as usual. So it's not the 600 to 700 that has standard utilization and are fairly profitable and fairly good revenue, because that group is probably straight down your policy already, and so you're already capturing them with the policies that you've had for 5-10 years that are pretty tried and true. What this segmentation acknowledges is that there are some harder choices with millennials because they are a riskier population. And so we combined the risk with the revenue side in order to help with the kind of the low side overrides. So if you look at the release segment, the Vantage score is 538. It's a really low Vantage score. I mean, it is subprime. The average revenue for this group, or this particular group of people that we selected, was only $343 for a year. And so that was low by comparison also. The average bank card utilization was really high at 78%, and then the delinquency of 90 plus days past due was 7.2%. So this group, because they have both a high risk score, or low risk score indicating high risk, and they have low revenue, that the recommendation clearly is to close the account, so release them. Probably wouldn't even do a credit line decrease. If it got this bad and this was on your portfolio, this is one that would be a close and look for other replacement for your portfolio. Now the watch also has a low Vantage score. It's still subprime, 586, so we're trying to find a group of population that was similar to the low Vantage score for the release, but it has a revenue of 674. Remember, the average revenue was 695 for this population, and so it's really pretty close to the average, which means that if you can mitigate the risk of this population, they could be profitable to you. So that means watch the average bank card utilization. It's still really high, but watch to make sure that it doesn't get too high on you. And the delinquency is high at 4.6%, but you might be able to work with them. If you are on the top of wallet and you are the card that they want to use and they prefer yours, then working with them closely and making sure that they don't go bad on you might be able to help your long-term, like lifetime value with this customer base in the long run if you're able to get over this short-term risk. If it turns into long-term risk or it turns into risk on you, though, you need to be prepared to do the appropriate actions like a credit line decrease or closing the account if it slips down to the release group. And then the next group is the Protect and Attract. Notice that these Vantage scores are high. This is in the 718 prime group. Average revenue is nearly $1,600. The utilization is still a little bit high, 41. I think the average was 40, so it's a good utilization, but I would still consider it a little high. And the delinquency is only 50 basis points. So if you have this group on your portfolio and they're millennials, you're doing great, and you should be attracting them and treating them well to keep them. And so in order to keep them, you should be doing credit line increases. That 41% bank card utilization tells me that they probably need some more credit. The 50 basis points tells me that they could probably handle some more credit, so it doesn't look like they're on the verge of not being able to pay something back, and they have good Vantage scores, so they've got pretty good credit behaviors already. So I'd recommend both the credit line increase, but also looking for cross-sales or graduation programs, because they probably have other credit needs that are coming up that you can address. And then finally, Experian has conducted a lot of surveys and interviews in addition to these quantitative analytics that we just showed you. And so we're trying to understand more about this population and this generation. And some of the key topics and messages that continue to come up from them are these that are listed in terms of inform me and know who I transact with. The couple that I want to point out are that contact me at the right time. Contact me at the right time is important because you have a lot of tools at your disposal to know when they need credit. And so to address those credit needs and to get them at the right time is easier now than ever with so much data that we all have. And then provide me with the best offer. Same thing here. We have so much data that we should be able to tailor the offer to them for what they need and when they need it. And recognize that they can get a lot of information online and they can see what the different offers are. And so if you're not giving them the best offer or the right offer for them, they may find something that matches them better and go with someone else. And so that provide me the best offer is something to keep in mind now more than ever because of the amount of information online. And then the last one I wanted to talk about was educate me. I've had so many discussions with millennials that say they don't know where to get credit education, and then we point them to a lot of different places they can go to, even online, if they don't want to talk to somebody. But provide them with credit education, because if you help them understand how credit works, then they'll be better customers for you, and you'll probably be able to help them be better credit users in the future. And so those are just a few of the things that popped out at me in terms of what millennials continue to say in these surveys. And then finally, let's see, we cover everything? Yeah. So in terms of our summary, we covered our trends. We talked about the cohorts and did the comparison of Generation X, pulling them back 10 years. We talked about entrepreneurs who are millennials and went through the segmentation, balancing risk and revenue. So I think we covered it all. So Reshma, back to you.
Yeah, thanks, Michelle. Hey, thanks for giving us that first look at this rich data and insight. So thanks for this sneak peek. I really, really appreciate it. We do have some time for a couple of questions, and we've been monitoring a few questions that have been coming in through the console. So please keep sending them in. If we don't answer them today, we will answer them in a follow-up. So, Michelle, here's a couple of questions that we've curated here. So the first one is, we saw that millennials are increasing their Vantage score, but how long will it take until they get to Gen X levels?
Okay, so I think the Gen X millennials were increasing, or the Generation Y millennial group was increasing at about 2.5 per year. So I would say that for them to increase 10 points, it'd probably be about 7 years. So they're at 629 right now. I'm taking a look at my notes. They're at 629 right now, and for them to be at the base of the Gen X, 644, I'd say it's 7 years. So 7 years, they should be up to about that point.
Terrific. Okay. Here's another one. So what's the current overall average debt of millennials compared to Gen X?
So the entire millennials and Gen X population. So knowing that not all of them have the same types of credit, like we looked at on one of the first slides where we isolated mortgage or auto or bank card, and that way you could really get each one of those products. If you do the entire population as a whole, U.S. is about 85,000, Gen X is 125,000, and millennials are 54,000. And the reason that Gen X and millennials are so different is because millennials don't have those mortgages still. I think we talked about that a couple times. Without that mortgage to bump them up, they're significantly lower than Gen X.
Okay. And then on this last slide, Michelle, you mentioned credit education, and I know that's a real hot topic. So, can we talk a little bit about loyalty, credit education, empowerment? What can lenders do to help with this lag in credit education?
Yeah, I saw this question come up, so I was able to pull something out for it. It's interesting because we did a lot of interviews with millennials, just man on the street style, and asked them where they got their credit education. And after about the fourth or fifth person saying they didn't know, there's credit education, they realized that was the wrong question to ask. So then we started asking them other questions to find out how much they knew about credit, period, because they weren't looking for credit education, which to me was funny because this is an age where you can't remember somebody's name in a movie, and you just pull out your phone and you hit IMDb and you find who that person is. But yet,
right.
This generation hasn't thought about credit education at all, or looked it up for anything, even for getting credit cards. So what we have done is offered credit education to lenders that Experian actually will talk to the consumer about their specific consumer report. And so it's about a 30-minute session, and it's really good because they even have some simulators that can help with debt to income, for instance, if they have a specific situation that they think this consumer needs help with. It's highly customizable in terms of being able to address that specific problem, like if it's home equity line of credit payment shock. We can talk about what a line of credit means and how much their debt to income will increase if they need that kind of education. So highly customizable. And the thing that I pulled up is we've been doing this for several years now and have found that after a year, a population of people who have received credit education, their Vantage score goes up by an average of 14 points, as opposed to people who didn't get this credit education. Their credit score is flat.
Yeah.
And so that's one huge thing. And it's okay. The other one that I just pulled up because I was looking for this while we were on the call is that external credit collection trades go down 21%. And so I think that it just really helps people to understand on their credit report what they specifically can do to make a difference and improve their credit profile.
Okay. Yeah, I mean, it's pretty complex for those of us that are not in the industry. So they should probably have this kind of education in every high school probably. So, well, listen, so thanks, Michele. I know, we've got just a few more minutes left, and I do want to remind people to keep posing questions and also remind people to fill out their survey that's located on the console so we can capture your feedback and learn about other webinar topics you'd like to see in the future, because these insights and data that comes from Michele and her team are just really, hopefully you find them really valuable. So we will follow up with any unanswered questions and additional information. So if that's not it, Michele, any final words? Otherwise we can say goodbye to everyone.
I guess my final words would be I hope that millennials are seeing that credit can be an excellent tool, and that anybody who's kind of afraid of it right now, if you've got millennials that you can influence or you're looking at your policies to help them, that let's help get them started off on the right foot.
All right. Thanks, everyone. Thank you so much for your time and participation today. We'll have a recorded webinar and some follow-up with all the unanswered questions, and stay tuned for more. Thank you so much, everyone.